Welcome back to Upside Down Data. Today I want to talk about what risk model is best. And to do this, we first need to define what is risk. When it comes to risk models, risk is usually defined as the risk that you'll experience a prolonged period of downside after potentially purchasing an asset. In this video, I'm going to be focusing on Bitcoin. So it's basically the risk that you'll take a position that will be in heavy loss going forward, and it might take a very long time for you to finally get back in profit. And so with Bitcoin, what you can see is that it's obviously very volatile. That's what it is known to be. All crypto is known to be very volatile. So there will be these periods of very high risk where really if you bought at those periods, it would take a long time for that position to again be in profit. And so that is really what risk models are designed to look for. They're designed to look for those periods when the market is really high risk, when it's probably best not to be acquiring the asset, and also when they're really low risk, when acquiring the asset is probably a good idea because it means that notable upside is possible going forward. Fortunately, these risk models exist. So the goal of this video is to do a deep dive to figure out how can we tell which one is best and which one might give the best returns when used. First, I think it's useful to introduce these models, what they are and what they're trying to do. So if you've been watching the channel for a while, you're probably very familiar with this model. This is our upside downside potential indicator, or UDPI. This is the long-term version of the model that cares about moves that play out over months to multiple months. And it is a risk model of sorts. Now, officially what it's doing is quantifying the amount of upside versus downside potential that's realistic for the asset in the given point in time. That is where the upside downside potential part of the name comes in. And so the way you can read this is that really high levels, so it goes from 5 to -5. As you get up to these higher levels, that means the upside potential is limited, the downside potential is quite large. Whereas if you're all the way down at the bottom of the scale, it means the downside potential is limited and the upside potential is large. So that's how it gets at that idea of risk, when is your upside potential limited relative to downside and vice versa. And you can see looking at it that it does a really good job of quantifying these high risk points in the market where protracted downside followed, and also these low risk periods where protracted upside follows. The model we're going to compare the UDPI with is this model, which I'm terming here risk model. Now, this is meant to be a stand-in for a whole family of different models that get at risk that produce output that looks very similar to this. Now, I want to be clear, this is a model that I built using one particular method. There are other people who have built models that produce output like this. I do not know what methods they use. I am just creating one that is a stand-in that gets to the output that basically that whole broader family would get to, though you could do it in a bunch of different methods. And I'm not trying to reproduce one in particular, just using a method that would give you the output like those other models would give. And what models from this family of risk models are trying to do is basically assess risk. So high values, high risk, low values, low risk. And I've scaled this model to be between -5 and 5, so that's consistent with how the UDPI is scaled. You'll see this in all sorts of different ways depending on the model. Some people scale it 0 to 1, some people 0 to 10, some people 0 to 100, and any other arbitrary different number of ways you could do it. I just did this for easiest comparison. And so the same idea. High values, high risk, good possibility of protracted downside coming off of there. Low risk, good chance of a notable bottom, notable upside following. That is the idea here. Now, the reason why we're comparing the UDPI to this type of model from this family of models is that this is really what's been considered the state of the art in the space for a long time. This type of risk model, you've probably seen it. It's viewed very positively by a lot of people in the space. So the idea is that if the UDPI can not only stand up to it, could actually beat it, then that would be a pretty notable accomplishment for the UDPI. So that's why we're choosing to compare it against this versus some other possible risk model that one could think of. So this is the comparison, the UDPI, which I built over here, and you've probably seen a lot of if you follow this channel, and then this stand-in risk model that I built over here. And we're going to compare them in a couple different ways. First, we're just going to compare them visually to see how they act a bit differently at different points in market cycles. Then we're going to do some extensive backtesting to see which one would yield better returns using the type of strategy that these models lend themselves to. So let's go ahead and just look at them visually first. So one of the first things that you'll notice when you look at these models is that they behave differently at bottoms or in the lows of bear markets than going into early bull markets. You'll notice on the long-term UDPI over here, it stays low risk for a long time at the beginning of bull markets. It gets low risk at the bottom of the bear market and then stays that way throughout the early part of the bull market. And it does that consistently throughout the different cycles. Whereas with the risk model over here, you'll notice that it doesn't stay at low risk points for very long. It's much shorter in how long it stays there. And why this is notable is that oftentimes the types of strategies, and we'll talk about this in a minute, that are used with risk models are about averaging in at low risk points and then averaging out at high risk points. So an advantage here potentially of the UDPI is it gives you more time to average in at good points, low risk points, than the risk model. Or basically it's better able to identify that these early bull markets are still low risk and good times to be accumulating, whereas the risk model here will not always give you that same information. And we just look cycle to cycle, we can see that very clearly. So look here in the cycle that went from roughly 2015 going into early 2018, basically here. You can see that the UDPI stayed very low risk for basically this entire time, and only really got high risk at the top, telling you to dump everything right up here. Whereas the risk model did get really low risk at the bottom of the bear market, but look how quickly it jumped up to about neutral risk, and it stayed there for a while. Then it was actually getting into higher risk points before you were anywhere near the top, before ultimately spiking to the top. This could be a situation where you wouldn't necessarily buy in as much as you could have, and you might sell out early relative to what the UDPI would have you doing. Likewise, if we look at the more recent cycle, we can see something similar, where in this interesting double top that we had in this market cycle, you'll notice that the UDPI got higher risk than the risk model did there, suggesting that this was not as safe of a point as something like the risk model was suggesting. Likewise, the UDPI dipped further in the summer of 2021 than the risk model did, giving you a better time to play this as a swing trade, basically buy here, sell here, whereas that was much less of a pronounced move on the risk model. And then finally, it stayed a lot lower risk throughout this beginning of this current run-up that we've been seeing than the risk model, which jumped actually to be above neutral just already here in early 2023, well before we were anywhere near the levels that we're at right now. So these are just some visual things we can look at that might suggest that there's possibility that the UDPI could maybe outperform the risk model in different scenarios. But that's all visual. That doesn't mean anything. We need to actually do some backtesting to see what is going on. So let's go ahead and talk about that next. The type of strategy that we're going to test in this backtesting is a dynamic dollar cost averaging strategy that basically entails buying or selling Bitcoin based on the UDPI or risk model level. And the reason why we're focusing on this strategy is it's by far the most advocated strategy for this type of model. So that's why we're going to focus on it in this video. So to quickly describe how this strategy works, basically you take your risk model of choice, in this case I'm showing the UDPI, and you choose some level that'll act as the dividing line between buying and selling. Usually that would be whatever the neutral level is. For the UDPI, it would be 0. And the idea is that anything above 0 is a sell zone, anything below 0 is a buy zone. And so what you're going to be doing is watching the UDPI or risk model level. And if it's below 0, that would be a buy signal. Above 0, that would be a sell signal. Now, how much you buy or sell depends on the level. So if you're around neutral, so if you're just a bit above, so between 0 and 1, you'll sell a little bit, but not too much. But then if risk goes higher, you'll sell a bit more. If it goes higher, sell more and more, until you get to the top of the scale where you're going to be selling out as quickly as possible. And vice versa, if you go down below 0, so between 0 and 1, you might buy a little more down here, more, and then the most all the way down at the bottom. So that's what we mean by dynamic dollar cost averaging. So you're averaging into the market, but you're doing so dynamically based on what the UDPI or risk model is doing. For the first backtest I'm going to show, we're going to use the exact same strategy and setup for both models. They're going to both start with $1,000 worth of Bitcoin. The backtest is going to start in late 2010 and go through to the present day. So basically over the vast majority of Bitcoin's price history. And we're going to account for trading fees. Basically, if you're buying or selling on exchanges, there will be fees you have to pay as a part of that. That will be accounted for. And we're also going to assess both models' performance against a simple buy and hold strategy also to see, can they perform just simply buying and holding? If they can't, that would be concerning. That's where we're also going to assess that. And here's the exact strategy that's going to be backtested. Basically, at different UDPI or risk levels, you will either sell or buy. And the amount is going to depend on those levels. And these weights that I'm showing you here is whatever percentage of cash that you have on hand or Bitcoin that you have on hand that you're going to be buying or selling respectively. So you'll notice that it is not linear. There's a little bit of buying and selling that happens at these really neutral levels, and then it grows and then gets most extreme at the ends. And the reason for that is that when you get to those really extreme high and low risk areas, you probably want to be getting in or getting out very aggressively. Whereas between there, you want to be getting in or getting out, but maybe not quite as aggressively. You usually have more time at those levels, so it makes sense to space things out a little bit more. So this is the setup for this current one. Again, the exact same strategy is being applied to both the UDPI and the risk model. So it's a fair comparison from that perspective. So what do we end up observing when we do this? Well, here are the results. This white line is the total value of the portfolio of the UDPI strategy. The red line is the risk model strategy, and the orange line here is the buy and hold strategy. So you'll notice risk model does outperform buy and hold, but the UDPI absolutely destroys the risk model and buy and hold. We can see this a little bit more clearly if we look at it on a logarithmic scale instead of a linear scale. Same idea. And you can see that with every cycle that Bitcoin goes through, the UDPI's lead increases. And really what's going on here is that the way that this strategy works, the way it makes you money and allows you to outperform buy and hold is basically by helping you sell the top and then waiting and then buying the bottom. That's it. That's how you compound. You compound by selling the top of a cycle and then buying the bottom of the next bear market, and doing that over and over and over again. And across multiple cycles, you will outperform the market by more and more and more if you're able to do that. So really what's going on here is it seems like the UDPI is more efficiently or better able to enable you to do that than the risk model. In fact, the risk model is only barely outperforming buy and hold up through here late 2017. And then it's really only getting notably above it over here in the cycle that went into 2021 and then going in more recently. But then again, the UDPI is way above it as well. So for this particular backtest, the UDPI did a lot better. And we can just look at the numbers to see what that magnitude really was. We can see the end totals for each of the strategies. Now, these are a little bit ridiculous, but that's because the strategy started at the very beginning. Bitcoin has gone up a lot in its history, so these numbers are expected when you're starting with $1,000. But what's really important is the relative performance here. And so that's where you can see the UDPI outperformed the risk model by 9.28x. Pretty massive outperformance. And the UDPI outperformed buy and hold by 22.101x, which is quite impressive indeed in my view. All right, but you might be saying, and fairly so, that this is just one backtest. Maybe I cherry picked this, and that if I had started the backtest at a different date, the results would have been massively different. And that is a great question. So let's go ahead and look at a different backtest starting at a different date. So that's what this is here. This is starting in late 2016, and then the exact same setup, the exact same strategy, everything else, and we see a similar story. Now, interestingly here, the risk model and buy and hold really ended up in about the same place. So risk model did not really outperform buy and hold in this backtest, whereas the UDPI, again, massively outperformed both. We can look at the exact numbers. UDPI beat the risk model by almost 3x, and it beat buy and hold by 2.86. So in fact, the risk model actually underperformed buy and hold here by a little bit. UDPI outperformed both of them. All right, but you might say, okay, well, what if that was just another cherry-picked backtest? How can we know we can trust that? Well, let's not just trust a handful of backtests. Let's do this more systematically. So what I've done next here is basically thousands of backtests over different 4-year periods. So the idea of a 4-year period is that that tends to be around the length of a cycle in crypto. Bitcoin, historically so far, has had bull bear markets that last in that 4-year general window. So the idea is that if these strategies really make their money by leveraging that volatility within a cycle, selling the top, buying the bottom, then we can evaluate their effectiveness in 4-year periods across Bitcoin's history. So that's the idea here. So we're going to start in late 2010 like we did in the last one. But instead of just going through to the present day, we're going to end 4 years later. Then what we're going to do is we're going to just run the strategy and compare them against each other. So just run a backtest in that period. We're going to record the results. We're going to then shift the start and end dates forward by 10 days. The reason for this is that doing it every day is a bit excessive. Things don't change too much in one day. But 10 days allows us to shift the starting date in terms of what day of the week it was starting at, then also give us a good coverage throughout it. And we're just going to rinse and repeat. We're going to just then do another back test over that new window, shift it forward again, do another back test, so on and so forth. And what this lets us do is look at averages, looks at overall, across all of these different back tests, across all these different 4-year windows, how is the UDPI faring against the risk model, and how are they also faring against buy and hold? And is it reliable that the UDPI outperforms the risk model in this type of setup? So let's talk about the results with this type of setup. So first I want to talk about the performance of each model versus buy and hold. So this is the UDPI, and the numbers here are the multiple performance against the other strategy. So 2.13x would mean a 2.13x better return than the alternative. So the UDPI on average outperformed buy and hold by 2.13x, pretty good. Median was similar, 2.01, suggesting that there's not a huge amount of skew in the distribution of returns from these different backtests. The minimum return over buy and hold was 7%, so that was the absolute worst it performed against buy and hold. And the maximum was 8.08, so 8 times better than buy and hold, again, in 4-year periods. These are shorter periods than we were talking about in the prior backtests. So pretty darn good in my view. Now let's look at the distribution so you can see it for yourself. This is what it looked like. So again, a few that were down around 1, with the minimum being 7% better, or 1.07x, and then all the way up to 8x better for the UDPI. But most of them clustering around that median, and then the mean that was around 2x, about 100% better than buy and hold. But now with the risk model, things look quite a bit different. So this is the risk model outperformance over buy and hold. On average, it was only a 14% improvement over buy and hold, or 1.14x. Median was almost just dead even, 1.02, 2% better than buy and hold. Not great. Minimum was 0.46, so actually underperforming buy and hold by quite a bit. And max was 2.84. So that's respectable, but nothing like 8x, for example. And if we look at the distribution, you can really see it. And this, in my opinion, is very concerning for the risk model. That if it's not really reliably able to beat buy and hold, then what's the point? Why would you not just buy and hold Bitcoin? Why would you even bother messing around with a model like this if it's not able to reliably beat buy and hold? I think this is quite concerning. And even though it does have this little pocket up here that's massively outperforming buy and hold, it's not doing so by nearly as much as the pocket that massively outperforms for the UDPI. So in those instances where massive outperformance happens, UDPI tends to get it better than what we're seeing the risk model do. So I think that is a concerning sign for the risk model in this exercise. And then if we just compare them directly against each other, we can see what you might expect given what we were talking about. The UDPI outperformance over the risk model, on average, it's 82% better, 1.282x. Median, almost 2x better than the risk model. Minimum is 10% better, 1.1x. Max is 3.15x better than the risk model. And here is that distribution. And you can see the mode, the most common here, is right around 2x better, 100% better than the risk model. So I don't know about you, but this to me looks pretty convincing that there's a lot of outperformance happening by the UDPI. And in fact, it's always outperforming the risk model in this test. If we just look at the periods of the start periods of when we started these throughout, whenever you started the back test throughout this whole thing for a 4-year period, every single period in here, the UDPI outperformed the risk model. So I think that's a concerning sign for the risk model, especially the fact that the risk model wasn't even able to reliably beat buy and hold. In fact, was on average just right around the performance of buy and hold is a concerning sign, whereas the UDPI did a lot better. Okay, but you might still say, wait a minute, how do we know that that strategy that you tested with those particular weights of how much you're buying or selling each day, how do we know that those aren't specifically tailored to the UDPI and that a different set of weights would have been different? So that's what we're going to do in this next exercise. We're going to do the same thing that we just did, but for every back test, we're going to randomize the weights in each back test. And so the way that this is going to work, or the way that I set it up, was that these top weights here that are currently 5%, those are randomly assigned to be between 3 and 7%. So I'm still forcing it to be relatively heavy here, but I think that advantages both models. I think that's just a thing. You'd want to be selling heavily at the top or the bottom. That shouldn't be any different between the models. But then all these levels in between will end up being lower. So this one, for example, will be lower than whatever this one ends up being, but then higher than this one. And this one will be lower than this one, higher than this one, so on and so forth. Because that's really the essence of a dynamic approach. You want it to be heavier as risk gets higher or it gets lower in terms of the weight. You want the weight to be going up. But then the degree of how that happens or how those are distributed is being randomized here. And the idea then is that we're going to just test a whole bunch of random different strategies that could be possible and see, does the UDPI still reliably outperform the risk model when we do that? And if it does, that would be even stronger evidence that it is reliably better, even if you choose a relatively random strategy to use it with. So let's go ahead and talk about how this was done. So as I just mentioned, those levels between 4 and 5 and -4 and -5 are randomly assigned between 3 and 7%. Then all the other weights then followed from there. Again, always being lower than the next higher one, but higher than the next level below. So then to look at the results of this back test, what we can see is that on average, the UDPI outperformed the risk model by 2.45x. The median was 1.68x, so 68% increase. Now, notably, there were some times where the risk model actually did outperform the UDPI in some of these randomized weights backtests. 0.82 was the lowest that the UDPI ever scored against the risk model. But the max was a whopping 26.62x, and the percentage of backtests where the UDPI outperformed the risk model was 94%. So that's really the space that we're working in here. We can just look at the distribution. That a few of them ended up falling such that the risk model outperformed the UDPI, but the vast majority, 94%, were such that the UDPI outperformed the risk model, and often to extreme degrees. I mean, even if you just look here, the number above 2, 3, 4, 5, 6, so on, there's a lot of simulations, a lot of backtests that fell in those areas, with, of course, that one outlier being all the way up here at 26. So that's just going to happen. When you do these backtests, there's always going to be some perfect strategy for one model versus the other. But really, if you're going to be saying that that's evidence that the risk model is better than the UDPI, I personally wouldn't go there. Are you really going to think that the next 4-year period is going to happen to be one of those times, and you'll happen to be using one of those strategies that would maybe get you an 18% uplift over the UDPI? Or do you lean into more of the fact that 94% of the time you get better returns with the UDPI, and sometimes extremely better returns with the UDPI than the risk model? So to wrap up, I think what these back tests show us in a pretty rigorous way is that the UDPI does seem to be able to perform better and navigate the market better than the risk model. That across basically all those different setups that we looked at, the vast majority of the time, the UDPI will be giving better returns than the risk model. And I think these model comparisons are useful because, again, the risk model, or this type of model, this family of model that I mentioned earlier, has often been held up as the gold standard of risk models in Bitcoin and in crypto more generally. But really with the UDPI, the whole goal of this model, the reason I built it, was that I thought that there was more that could be learned from the market, that there was a better way of doing this. And the UDPI uses an extremely different approach to assess its upside versus downside potential, which we often will just call risk, that I think gives a lot of utility that I think has been shown over the risk model over here. And model comparisons are important. You'll see that all the time if you look at computer science journals or anything where people are proposing new models, they always will show how it performs relative to other gold standards that are out there or states of the arts. And if you can't outperform what already exists, what's the point of the new model? I think that the UDPI has shown itself to very much be able to outperform the current state of the art. And that's why we rely on this model. That's why I've been talking about this for so long. This is why it's on our website, claritydigital.io. Link in the description if you want to see it for yourself. That is why we tend to talk about it. And the other advantage of the UDPI over the risk model that I haven't gotten into here, but I'll briefly mention now, is that the UDPI is generalizable. You can apply it to a whole host of different assets in the crypto space, and you don't have to change anything about it. It's the exact same model. You just apply it to the new asset, and it's off to the races, and it works very well. Whereas with the risk model, these have to be tailored to specific assets. They can't just be generally applied like that. There's much more risk of potential overfitting with these than something like the UDPI. There are other limitations of the risk model that go beyond just its performance, just in terms of how it's created. And that's another reason why I took the approach I did when building the UDPI, was that I thought I could make a better, more generalizable model that could be applied beyond just Bitcoin, whereas the risk model is a little bit more limited in that respect. So make of this as you will, of course. Make of these data as you will. Tell me what you think in the comments of this comparison. Do you think that the UDPI is convincing in terms of its outperformance? Are there other analyses that would be useful to see? I want to have a discussion about this because this really hasn't been done yet in the crypto space that I'm aware of. No one's really done such a systematic review of one model versus the other and really putting them through their paces and see which ones outperform. So I hope you found this useful. All All right, if you like the content, remember to subscribe to the channel, give the video a like, and follow us over on X. A lot of updates about our models and more over there. And you can go to our website, claritydigital.io, to see live data from our models and more.